Okay, let's get started. Well, welcome everyone. Good morning, good evening, depending on where you are in the world. I am broadcasting from our New York City location in the World Trade Center. So behind me is our office and below me are 84 floors here at the World Trade Center, a very apropos setting for today's webinar, Money Talks, Venture Capital, Chasing the Unicorn. So let's go ahead and get started. For those of you for whom this is your first Cadence webinar, I'll explain the purpose of these webinars and how you can take away a lot of information from it. So I always like to start with a quote. This was a sarcastic quote I saw on social media. August hasn't ended yet, and we already have 113 meetings scheduled with Series A and Series B stage tech startups next month. Our deal flow has never been stronger. You may not understand why that is so funny right now, but I promise you by the end of this webinar, you will. And if you're still not sure, you can ask me in the Q&A afterwards. So today, what are you going to learn? You're going to learn about, well, simply put, what is a venture capital firm? You're going to learn about how do they make money? You're going to learn about what does it mean to chase unicorns? Unicorns is probably an idea or a concept you know, but why are VCs so set on going after them? And what are some of the tactics they use? That's what we are going to be discussing. Now, we run these because we are, at the end of the day, an information services company, and we're very passionate about engaging our community, leveling up their understanding of the broader finance world out there. So for interpreters, transcribers, or translators in attendance, pay particular attention to any of the words that are in red. They are defined terms that will come up if you work in this industry. And we've also thought about applying this to words that just kind of sound funny, like dry powder. Right? What does that mean in this context? You will receive a glossary of these words at the end, so don't worry too much about taking notes. Just enjoy yourself, ask questions, and let's get started. So what possible qualifications do I have to be leading this webinar? Well, I did work for 4 years as an investor at Hudson Capital Management. It was a firm about, I don't know, like 8 miles that way across the Hudson River here on the East Coast. I work with venture capitalists daily as clients. Even today, I've been meeting with new VC firms that are saying, look, we have an international set of deal opportunities. We need a reliable language partner. And as you'll see shortly, I feel that it's important that I do have experience in this industry. I know my way around cap tables and term sheets. So what exactly are cap tables and term sheets? Well, these lay out the specifications for how investors and companies interact with one another. The term sheet is effectively the description of the economic deal that the venture capital firm is willing to offer to the company. And the cap table is a ledger that shows who owns what in terms of the equity in the company. So we'll go into this a little bit later, but just to give you a sense of why this is a topic I'm very passionate about. Not only is it in my background as an individual, but it is very much in Cadence's background. This is me on stage at 500 Startups, a well-known venture capital firm in California. I was pitching Cadence to an audience of several hundred investors. We ended up on the conclusion of that program raising some money, which I'm happy to talk about in the Q&A, because it really is transformative, not to just us as a company, but to capitalism in general and how entrepreneurs and founders can get funded. So it's a topic very near and dear to my heart. Very excited to be sharing it with you guys today. We're going to start at the basics. For those who have been in our webinars before, hopefully you know by now that we always like to just begin with fundamentals, because we think that in general these are concepts that people hear quite often, but they may not have a full grasp of the fundamentals. So we're going to start with, what is a venture capital firm? And quite literally, you can think of venture capital as investing in privately held high growth companies. If that's all you know about venture capital, that's perfectly fine. We are going to unpack it in a lot more detail over the next half an hour or so. All right, so we're going to begin with a plain English introduction to venture capital. The way I want you to think about it is a venture capital fund takes people's money and invests it into other companies. They will make money when the value of their investment goes up. And we'll define what that means, value of their investment, in a second. And their investment strategies are all about picking winners early. I'm wearing an Apple Watch, right? If you picked Apple 20 years ago to be a winner, you would not be on this webinar, you would be on a beach somewhere. So it's all about picking winners early. Let's go into a little more detail though. A venture capital fund, they are raising capital from investors and they are investing that in a portfolio of privately held companies. In my experience, everybody knows the second half of that sentence. Not a lot of people appreciate what that first half of that sentence means. It quite literally means that these venture capital firms, they have to go out and pitch themselves. They're just pitching to a different audience than the average startup entrepreneur. I'm going to define that in more detail in a second. Now, I said that they make money when the value of their investments goes up. Let's put a little more detail around that. You can see here that they have money, or excuse me, they make money when their portfolio companies have an IPO or a trade sale, or when later stage investors buy them out. Generally speaking, the first set of outcomes is far more common than the second set. And finally, we say that their investment strategy is focused on picking winners early, but it's a little bit more than that because you have to identify high growth companies and you have to convince them to accept your financing. These are not publicly held companies where if you like a company, you call up your broker, or more likely you go online and you can buy shares. That is not how this works. There's a very human element to this market because you are talking about transferring millions of dollars back and forth, and thus the role of trust and building a relationship is so, so important. So for anyone multilingual listening to this webinar, this will be something where you can see how you as a language service provider can make an impact. So I'm going to go through this set of terms one last time using more specific terminology. So a venture capital firm is made up of general partners, also known as GPs. They are raising their capital from limited partners, also known as LPs. And when they raise this money, they colloquially call that money dry powder, and they are deploying that money into seed rounds, Series A rounds, Series B rounds, Series C rounds, and it goes on. I think Uber is on their Series H or something crazy like that. Now, we said earlier they make their money when the value of their investments goes up, and I said that that could be a trade sale, that could be an IPO, that could be them getting bought out by later stage investors. More generally, you can think of it as when there's a liquidation event or when there's a recapitalization. A liquidation event were those first two scenarios, IPO or trade sale, right? A recapitalization is when, hey, we were pretty early investors, we're getting kind of bored, we don't want to sit on this investment anymore, can we sell our shares to another investor? That would be a recapitalization. Finally, their investment strategies are all about picking winners early, but one of the terms you'll often hear in this industry is sourcing. And you'll also hear deal flow. And you can hear these together where it's all about how good our sourcing is, how good our deal flow is. And as a result, you will be participating in these Series A, B, C rounds. And sometimes you may be a lead, meaning you are the one who is dictating the terms of this investment. Sometimes you may be a follower as a venture capital firm. What does that mean? A follower says, I like you guys, but I don't want to be the one that sets the terms of this investment. Go find a lead. We will come alongside them. Okay, so this was a lot of text. It was the same concept explained 3 times. The rest of this is going to be a little bit more interactive with examples and whatnot. The goal of this was just to get you increasingly comfortable with both terminology, increasingly comfortable with the complexity that this process entails, and give you a preview of how language service professionals can really make an impact. Now, let's talk about the reality of how this works out, right? What does it mean to be in venture capital and meeting with entrepreneurs and chasing unicorns? Well, some of you may know the show Shark Tank. This is the US version. I believe it's been internationalized in dozens of countries. But what you're seeing here on the right side of your screen is an entrepreneur who is sharing their vision. I've literally been in that role hundreds of times with Cadence probably, although I was never on Shark Tank for reasons I can get into later. And on the left side, you have professional investors, the sharks as they are known on this show. So it's 5 of them. Some of them are actually celebrities. The person closest to us in the photo is Mark Cuban, a very famous entrepreneur turned basketball team owner turned celebrity. And then you have lesser known people that have still made their fortune as venture capital investors. So a lot of people think that this might be how pitches are done, where you walk into a room and there's 5 people there. That's definitely not the case, particularly for early stage deals. This is a photo of people riding bikes. A lot of people don't know this, but the reason that we, Cadence, got into that 500 Startups program was in large part initiated by the fact that my co-founder, Jonathan, went on a bike ride with someone who happened to be a partner there. And so in the course of riding bikes together, Jonathan pitched our company to this venture capital firm. And the venture capitalist said, hey, this sounds interesting. Why don't you come to my office later this week? So, you know, the butterfly effect, who knows what would have happened if Jonathan had never gone on that bike ride. But the point is, these pitches can happen anywhere. If we have any people tuning in from California, I highly recommend you visit this cafe. It's called Red Rock in Mountain View, and it is famous for a meeting place where VCs and founders will meet either surreptitiously, where they see a developer on his laptop and someone comes over and asks him what he's doing, or it's a planned appointment where maybe you've emailed a VC or you've DM'd them on Twitter and you said, hey, let's meet at Red Rock. So wanted to give you guys a bit of a flavor as to just how this plays out in real life. I know all of our examples are from the United States, but this is something that really is a global phenomenon, particularly these early stage deals where they can just happen from anywhere. All right, let's go into how do these firms make money? We've talked about, well, they pick winners early, and then they're going to find liquidation events, et cetera. But we really want to give you that next level of understanding. So I'm going to do something called follow the money. And this, I think, is a really good way to ask yourself, okay, do I understand all the different players? Do I understand their motivations? So I think this is probably the most important part of the webinar and understanding how the system works. So you can see here, you have limited partners, you have general partners, you have portfolio companies, and you have new investors. I'm going to go through each of these arrows to explain where money comes from and how it moves through this system in the attempt to chase a unicorn. So how does money go from the limited partner to the general partner? Well, a limited partner is a source of institutional capital. You can see here, I say it's Stanford University's endowment. It could be your company's pension fund. It could be your city's assets under management. It could be your country's sovereign wealth fund. The point is there are hundreds, if not thousands, of really large institutional investors out there that say, you know what, I've got some low risk investments and I've got some high risk investments. If I put my money into you, the general partner, my expectation is that you will triple my money in 7 years, right? That's a lot better than you would do if you just put your money in a savings account, right? So there's clearly some risk tolerance that the limited partner has when they invest in the general partner. What's next then? So let's say a general partner is talking to a portfolio company, right? So this is the case you're probably all thinking of, right? A entrepreneur like myself talking to a venture capital firm about, hey, can you invest in me, right? I've got a great idea, let me tell you about it. Now, what the general partner would say to the portfolio company in this case is, okay, I am on the investment team at this venture capital firm. If I give you $10 million, I want you to give me $500 million in 5 years. So let's pause there for a second, right? If I go back and I just told you guys that limited partners say, hey, venture capital firm, if I invest in you, can you triple my money? So why am I telling you here that those firms in turn take that expectation, and when they meet a startup, they say, I don't want 3x, I want 50x. That is the crux of venture capital versus private equity or other forms of capital deployment, which is that they are really swinging for the fences, if you will. They are wanting to get very, very large wins, and they assume that that will offset other losses in their portfolio. So VC firms, and I know this from experience being on both sides, they're not happy with a company that goes from 20 million to 40 million, right? Even though that might be a phenomenal outcome for the management team and the founders, they're not satisfied with that. They want massive, massive growth because they know that they are in a hit-driven industry. Hence the name of this webinar, Chasing the Unicorn, right? Their economic expectation is that they get 20 or 50 or 100 times the investment on their, return on their investment. Okay, bear with me. Now, what happens when these firms that were able to raise money, they at some point need to raise more money down the line? So you can see here, a portfolio company might say to a new investor, hey, we are the hottest startup in the Valley. Benchmark led our Series A. Are you in for our Series B? Right? This creates the classic herd mentality of, oh, we're the hottest startup. Don't you want a piece of us? Because if you don't invest in this round, you're never going to get a chance again. So portfolio companies, they need to go out and raise even more money from new investors. Now, let's say the new investors are interested. They might turn around and say, okay, I'm sold. I'm in for your Series B. I'll give you 50 on 30. 50 on 300. What does 50 on 300 mean in this case? Well, it means we will give you $50 million and the valuation of your company will be $300 million. So if I'm giving you 50, and let's say that the so-called post-money valuation, which is a term we should put in the glossary, we'll add it, effectively means that they own 1/6 of the company, 50 over 300. Right? So the new investors are saying, all right, I'm going to give you that capital. I have some expectation for how many shares this buys me. So go off and conquer. Now at this point, the portfolio company might be on a path towards a monetization event, which we talked about earlier, or a liquidation event. So they might say, hey, we closed our Series B and we got a buyout offer afterwards. In this buyout offer, we're going to get $1 billion. And the portfolio company might ask the general partner, so if the whole company gets $1 billion, I know the guys we just took money from, they're going to get the money first, probably, and then you're going to get the money second, and then I get whatever's left over. So that's the basic idea, is that as you follow the money, you need to remember that it's most frequently the last investors who get paid first. So there's a lot of tension around this concept of the waterfall and the idea of, okay, how much does the general partner retain when they make an investment? Now, finally, just to close this loop, the general partner, the ones who raised money from those institutions like Stanford's endowment, they are going to say, hey, on a portfolio basis, our fund had these successful exits and it resulted in a IRR, a internal rate of return, or the way we can think about it is a annualized rate of return of, call it 30% gross, 24% net. So let's unpack this for a little bit. If you remember, what kicked this off is Stanford saying, I give you $100 million today. I'm going to give you 7 years to give me $300 million. And yes, I do see the typo there. Thank you. If you know how to infer percentage growth numbers, if you took 100 million and you had 7 years to get it to 300 million, that's about an 18% return every year. So if the fund says, hey, you wanted 18%, I got you 30%. Actually, I got you 24% because I took some fees. That's the difference in these two numbers. You have the gross IRR, which is total cash received over total cash invested. And then the venture capital firm, they retain some fees. And so the final return that goes back to the original investors is reduced because the venture capital firm gets those fees. I covered this in my private equity webinar. I thought it wasn't really relevant for this one, but if you're curious about those fees, ask me in the Q&A or check out our private equity webinar. Now, it's important to note that chasing unicorns is hard, and becoming a unicorn is even harder. Here's some data from CB Insights, one of my favorite companies and located just 50 blocks north of here. They said that of about 1,100 US seed tech companies, meaning companies that raised a seed round, you can see the progression that they go through, where some of them raise a second round, some of them die. Some of them raise a third round, some of them die, et cetera, et cetera. And the takeaway of this illustration is that only 1%, you can see in the corner there, of that original cohort end up making it to unicorn status. Quite frankly, the odds are even worse than that, because even getting to this 1,100 USC tech company threshold is quite a challenge and quite an achievement in and of itself. So let's look at this another way. Let's look at what is the dream evolution for venture capital firms. And you can see it here. If this were a live audience, I would ask you guys to guess what company this is. It starts with U, ends with R. It's Uber. This is a chart showing their valuation and how it increased over time. And it is one of the most tremendous success stories. I was at Stanford in 2010, and I remember getting an email that said, Travis Kalanick will be on campus speaking about his $10 million Series A round. And I was like, too busy. I don't need to go to this, right? Who knows how my life would have been different if I had attended that. The point here is that you can see valuation kind of crept along for a couple of years, and then it had a jump up at Series C, and then a real rocket ship thereafter. And so if you invested at the Series A, the Series B, the Series C, even that Series D, you're feeling very, very good about the value of your investment. Some of the feedback I've gotten on these webinars in the past has been that you want to see more numbers and more real-life examples. So let's go through what this looks like for WhatsApp, a service I'm guessing everyone on here uses every day, or you certainly have it on your phone. So this was the sequence of events for WhatsApp. I'll talk about it here, and then we'll go through the math in a little bit of detail, nothing to be intimidated by. Basically, in 2011, so I was still at Stanford and just getting ready to leave, Sequoia Capital invested $8 million. And they would keep on putting more money in because they saw the growth of the team, they saw the traction that the app was getting, and they would eventually deploy $60 million into WhatsApp, right? So this is the general partner investing in the portfolio company layer. Now, 3 years later, Facebook buys all of WhatsApp for $16 billion. It was just a mind-blowing amount, which in retrospect seems logical just given the engagement and the high frequency of use on the platform. What was less reported, but is very relevant, is they didn't take $16 billion out of Facebook's bank account and transferred it to WhatsApp. That would be nice. They took 25% of that purchase price. So they took $4 billion out of their bank and transferred it to WhatsApp. And then they financed the rest of that $12 billion with equity. So they literally took Facebook shares that either they owned or they issued more, and they gave that to the owners of WhatsApp. Now, here we are 4 years later. Facebook shares have appreciated, meaning they've grown in value about 140% since the date they acquired WhatsApp. It was a little bit higher, but then they had Cambridge Analytica. Everyone knows that story. But the point is their shares went up. So just looking at the numbers here, you had $60 million of cash invested. The day of the exit, when WhatsApp received $4 billion as a bank transfer, then the firm, Sequoia, they were able to get a percentage of that. So people believe that just that cash portion of the exit event gave them $600 million, and they got about $1 billion worth of Facebook shares, right? So You pay 60 million in, you get 600 million of cash, so that's a 10x, and you get $1 billion of Facebook shares. I will take that as an outcome every day. And just to make it even more compelling to investors, those Facebook shares have gone up tremendously. Now, we don't know, nor will we ever know, how many of those shares, I had the lights go out, that's always amusing. Okay, no worries, we'll move this way. We don't know how many of those shares were sold between now and then. So if Sequoia held on to all of those shares during that time, those shares would now be worth $2.4 billion. So you can see from a $60 million investment, you get a 40x increase on that investment in 7 years. Really just tremendous, tremendous growth. I'm sorry, it's actually 50x because you got the cash earlier and then you held on to the shares potentially. Okay, so we're halfway through the webinar. We're going to do one more section and then we'll open it up for questions. So if you guys do have questions, do start to think about them because it'll be good to have some Q&A at the end. So what does it mean to chase unicorns, right? Unicorns, we should define, for those of you who don't know what it is, it means a privately held company whose valuation is $1 billion or more. In the world, there's several hundred unicorns at this point. People will say, oh, such and such company became a unicorn, or, oh, I used to work at a unicorn. There's also the variant decacorn, which are companies worth $10 billion or more. Maybe in the comments, someone can say if there's a word for $100 billion private companies. But at this point, unicorn is what we're going to focus on. So CB Insights, again, the company I mentioned, said that these are some of the top unicorns in the world, Uber being the most valuable, Didi, which my whole team in Beijing uses every day, being the second most valuable, so on and so forth. In case you guys are wondering, Cadence is not yet a unicorn, but it is certainly an aspiration that all founders have for their companies. So here's where we start to talk about the importance of chasing unicorns and the importance of marketing more specifically. So there's this interesting phenomenon where you have all these venture capital firms who are very, very active and engaged on social media. So here's 3 of them, for example, where you have GGV Capital. They manage quite a lot of money, and they've done about 5,000 tweets over the years. The firm that I mentioned earlier, 500 Startups, they manage far less money than GGV, but they have 4 times the number of tweets. And this extends not only at the institutional level, meaning the VCs themselves, but also the individuals. So for example, Benedict Evans works at one of the most prestigious and well-known venture capital firms called Andreessen Horowitz, and he's done 100,000 tweets over the years. And so there's really this mindset of I have to get my name out there, I have to get my firm's name out there. Now, if you were in our hedge fund strategy webinar, you would have heard us describe the relative secrecy or the low profile that a lot of these hedge funds have. And so you'd be hard pressed to find a hedge fund that has a social media presence as active as any of these. But that is the importance of chasing those unicorns, right? Whereas hedge funds, they have access to an infinite amount of investment strategies. For the venture capital firm, the only way that they make their money is if they happen to pick that winner early, and if they're able to convince that management team to take their money. So having a public profile is incredibly helpful. And for any translators who are watching this, it's also quite nice because it means they're generating a lot of marketing material, they're hosting a lot of events, so oftentimes they do want them to be multilingual. So let's talk about kind of why this is such a chasing unicorn phenomenon, right? So let me ask, is venture capital a buyer's market or a seller's market? Now, what do we mean by that? Well, if it's a buyer's market, it means that startups, they have the market power and they can command whatever terms they want from VCs, right? If a couple of years ago you said, I am a blockchain company built with AI and computer vision, right? VCs would say, take my money, right? So certain sectors within VC can be buyer's markets. They're very hot, right? And that can be defined, or that can start from a number of things. It could just be, oh, there's a massive acquisition in the space. It could be because there's a really famous founder who's decided to move into this. A really good example of this last one is legal tech, meaning startups that are focused on improving the overall legal industry. And there's a very, very famous entrepreneur, Justin Kan, who started a number of companies, including Twitch. And after selling that firm for $1 billion, he said, okay, my next venture is related to legal tech. And people just said, oh my God, I'll do anything I can to invest in you, Justin. So that was a buyer's market. Seller's market, by contrast, is VCs have all the power. In China, there was a very buzzy word, O2O, online to offline, where if you were a O2O company 3 years ago, it was a buyer's market. But quickly, as supply and demand tends to do, there was too much capital that rushed in. All of a sudden, it became oversaturated. And so now O2O is a seller's market. VCs can really dictate the terms that happen in any O2O company looking for funding. So you can see here, my conclusion is that when a sector is hot, the startups have the market power. If a VC is hot, so I mentioned Andreessen Horowitz earlier, I mentioned Benchmark earlier, then almost regardless of the industry that the startup is in, the VC has the market power. And similarly, like the Justin Kan example I mentioned, you could have a founder who themselves, they have buzz around them. And these messages, they get echoed through the media. TechCrunch is one of the most well-known sources of venture capital information and news here in the US. In China, it is iHema and 37KR, I believe. I think I got that number right. So there really are just no shortage of places to follow the hot deals or the hot exits or the hot VCs. Because of this, VC investing is basically a marketplace. You have a lot of buyers and you have a lot of sellers. As a participant in this marketplace, you have to do both inbound and outbound prospecting. Right? When we were raising money for Cadence, sometimes people would come to me and say, hey, I heard about your company. Can I have coffee with you? Sometimes it was the opposite, and I had to go out there and ask for those coffee chats. I had so many coffee chats over the course of this company's life. But the point is, even as a founder, you have to do inbound and outbound prospecting, and at the VC firms as well, particularly the junior folks who work at these VC firms, they also have to do inbound and outbound prospecting. So if you remember, we opened up this webinar with a quote about, oh, our deal flow has never been stronger. We've got hundreds of meetings on the calendar. It kind of speaks to that mentality of, oh, well, if we have hundreds of meetings, that means we're definitely going to be able to pick a winner, which is not necessarily true. So that's why it was a sarcastic remark. Now, in marketplaces in general, you can very quickly conclude that brand is incredibly, incredibly important, right? Not a lot of people know the actual performance of these VC funds, although you can find it if you're clever, but people know the brands, right? Whereas in the hedge fund world, there are hedge funds that are phenomenally successful that you've never heard of. So branding in general isn't very important in that world, again, because the hedge funds don't need to chase unicorns. The VCs have to chase unicorns, therefore they make significant investments in their brands. Okay, so to wrap up here, when can you help chase unicorns? So I have three options here. Do you think it's in the sourcing and pitching stage, meaning VC firms and entrepreneurs are kind of dancing, doing a speed dating thing? Or do you think it's in the diligence and the negotiation phase, that portion where they say, hey, we like each other, but we need to figure out how serious we are about one another? Or do you think it's in the post-investment support stage where, hey, the money's been deployed, now we just want you to grow like crazy and be the next Uber or Airbnb? So which of these do you think language service professionals can help out in? Well, hopefully you're encouraged by the fact that it's all three. So let's go through them one by one. Sourcing and pitching. And this is the part in the webinar where we introduce some gifts. So it could be helping a VC attend a conference, right? Maybe a VC hears that startups in Indonesia are hot and they want to prospect for that, but they don't speak Bahasa Indonesian. So they need an interpreter to help them. Or maybe you start on the other side. Maybe it's an entrepreneur who's in America and says, you know what, I'm going to China. I want my pitch deck in Chinese, even though I'll be speaking in English, but I want to hand out materials. So you can definitely help in the sourcing and pitching stages of this. Oops, skipped one. Could also be the diligence and the negotiation stage where two parties are quite frequently literally at a negotiation table and deciding, do I want to go into business with you? Yeah, your product is great, but maybe there's a lawsuit that you're facing. Or maybe from the entrepreneur side, well, I've got this VC offering me these terms. This other VC is more prestigious, but the terms aren't as good. What do I do? So specifically, how you can help as a language service professional is maybe you're helping a VC with an expert network call. If you're not sure what an expert network call is, we actually do webinars on that particular slice of the due diligence industry twice a month. So commercial for that. Alternatively, maybe you're just helping with document translation because this is the stage where people might say, okay, well, we want to read the agreement among the founders and make sure there's nothing weird there. And maybe that agreement was in Japanese and you're trying to get a British investor. So you can also help in this phase. Finally, post-investment support. This GIF is from Silicon Valley, the TV show, which if you don't watch it, I highly, highly recommend. It's one of those kind of dark comedies where if you're not in the industry, you may think, oh, there's no way that this can actually happen. If you are in the industry, you're like, that's tame. It's far worse in reality. So in this particular scene, there's a character who is riding a unicorn and throwing money around. So it represents the kind of, hey, we've made the investment, let's go become unicorns. So one example of how you could support that might be a CEO who is maybe traveling somewhere for supplier negotiations. In Cadence's early years, we were contacted by a CEO in California who was traveling to China to find and qualify different factories for their product. He didn't speak Chinese. He didn't want to bring a Chinese-speaking friend with him from the US, so he hired us. You could also, on the marketing and investor relations side, maybe you can help a venture capital firm with their LP meetings. Typically, venture capital firms host an annual event where they bring the CEOs of their portfolio companies, they bring all of their investors into a room for a whole day, and they just give updates. So if you have some of these firms that maybe they invest in one geography and they take LP investments from another geography, they're all in a room together, odds are that they're all going to want to be able to listen in a language, in their native language. So that's a very massive opportunity in general for the interpretation industry. Okay, folks, so we are at 40 minutes. So this is the point where I do open up questions. Happy to answer anything about what maybe you didn't understand from this. If you want some more personal anecdotes from mine and Cadence's history. And if I don't get any questions in the next few minutes, what I'll do instead is just kind of talk through some of these defined terms that are on here because they really kind of help shed light on things that I might have glossed over. So let me open it up for questions and we will go from there. I don't know how to turn the light on in this particular part of the office. So I'm gonna stay in poor lighting conditions while we do Q&A. Still waiting on some questions to come in. So folks, if you do have questions, please don't be shy about typing them into the Q&A box, which is down in kind of the middle of this screen. Okay, well, certainly if people have additional questions in the next couple of minutes, now's your chance. We do run these webinars fairly frequently, so we will be able to answer these again if nothing is burning on people's ears right now. We did get one question, which was, how do VCs predict or plan the timeline for the return on investment of the companies that they deploy capital into? So in other words, Stanford says, all right, guys, I'm giving you 100 million today. You've got 7 years. So how do they manage a portfolio of investments to do that? Very wonderful question. The answer there is that they're generally going to spend the first 18 months prospecting. They're going to deploy capital in really kind of year 2 or year 1.5 and year all the way up to year 3 or year 3.5. And they're going to relatively quickly know if they're going to make follow-on investments into these companies. So they may say, hey, I did 10 million into this company, but I think they're going to die. We're done. Let's not invest in them. Or they may say, all right, well, this company is clearly doing well. We need to reserve capital for future deployments into this company. So what'll often happen is if a VC firm really loves a particular investment opportunity, they may secretly allocate 20% of their available capital to this, but they'll only give out a little bit at first, right? And so they're saying, okay, let's put in a little bit, but let's reserve some capital for future deployments into this portfolio company. So in having this mosaic of companies that are different stages, they've already made the investment, but they're starting to get data and they're starting to get market feedback as to which ones are going to die and which ones are going to grow. They can use that to evaluate what the best schedule should be for the return on investment based on that original investment. So if you guys noticed, I did bring a new tab in here. I do like to say if people are curious about more information, where can they go to learn? This was a particularly impactful podcast episode about a very, very famous entrepreneur here in the US called Eric Yuan, who created Zoom, the platform that we are all on right now. Really, really touching story. And he's interviewed by one of his investors, GGV Capital. And he talks about the story of, well, I worked at a big corporation and then I decided I wanted to build my own company. And then I had to talk to investors. And then at some point, my company was already profitable, so I didn't need more investors. But then I met this one investor, Sequoia Capital, who really impressed me. So even though I didn't need the money, I took it anyway. Really, really compelling narrative that Eric has. Highly recommended it. He's a very, very inspiring entrepreneur to myself and Jonathan, my co-founder, and just this podcast in particular gives you a good sense of the dynamics in the venture capital industry. So, okay, folks, well, we do block out an hour for these webinars, but I'm sure people will not complain if I give back 15 minutes to everyone. My email is matt@cadencetranslate.com if you had a question that you forgot to ask or didn't want to ask in a webinar setting. And in general, I encourage you to sign up for notifications for our Linguist Academy, which you can see here on the page, cadencetranslate.com/learn. We do a couple different webinars as part of that. The one you just saw today is our monthly deep dive into an element of the finance world. And we also do recurring webinars, same content, just repeated a couple times a month for what is due diligence, because that is one area in particular that I think is quite impactful, but not everyone has a common understanding of. So really thank everyone for their time today. Hopefully you learned something about chasing unicorns, and looking forward to more webinars in the future. So Matt Conger signing off from New York. Have a good day. Thank you.